All right, folks, welcome back. This is the algorithmic theory lecture and discussion for price action model number 10. It is a swing trading model, stocking 50 to 75 pips per week. And again, focusing on the weekly range expansion specific to day of week. And we use external range liquidity in the direction of the weekly range expansion. So when we're looking at this model, we're looking for external range liquidity with external range liquidity. So as an example, we can see this high here. Right above this high would be buy side liquidity. It runs it. We look to short that and wait for our short-term low in a discount to form. When the market trades below that, then we cover or offset distribute there with the resting sell side liquidity. So we're selling buy stops to get short, and we're buying sell stops to cover our short. So basically, we're waiting for short-term highs to form when we're bearish, and we expect the range expansion to be down. We'll wait for our short-term high to be pierced. We'll sell short to those buy stops, ride it down to a future short-term low. So in other words, we're going to be waiting for a low to form, and then once it drives below that, then we'll pair that sell-side liquidity pool with our cover, or buying it back from those willing sellers below the marketplace. Now, this can be obviously a little bit scary, and the rules and such have been shown to you in the presentation and the model and plan, but you see me doing this a lot. But when you hear terms like external range liquidity, it can be a point of confusion, because one could argue that from this high to that low, isn't that internal range liquidity? Yes, if you're going to refer to that range there. But I'm looking at this range from that low to that high. So when we went above it, the buy stops would be resting above here. Because of the short that took place here, traders would be putting their stop right above that. And if I'm bearish, I want to see it run above that, knock them out, disrupt their short position, let me assume that short position with smart money, then ride it down to a discount from low to high, equilibrium, fair value gap. We trade down into it, wait for a short-term low, and drive down below it, and then cover. Okay, so this is the idea. Now this is when you're expecting it to go lower. If we look at the E-mini S&P, same premise here, but I'm going to be using it for a bullish scenario, and this is something actually executed on so you can see it. So we had a low to high, equilibrium would be resting in here. And when the market trades down into that small little gap, we're in a discount and a fair value gap, so we can anticipate a rally. And we want to see if it can run above the short-term high here or rebalance some of this in this area. So if we're looking at E-mini S&P, and this is a 1-minute chart, the question is going to be what is the range? Like, what is the range to define external range? Well, you want to think about dealing ranges. Okay, and when I say dealing ranges, I want you to kind of think of it as a trading range. Okay, just how the market will stay within like a consolidated rectangle-ish kind of area. It may not look like a rectangle to you, but over time when you start referring to dealing ranges like this, you'll see why and how I frame them out. And this is one example of it here, where we have sell side external range liquidity. And I want you to imagine this little area here as a box or a rectangle. The market is dealing between this high and that low until we get below that low here. So liquidity above would be buy side and below would be sell side. I'm only interested if I'm bullish for the sell side. So sell side external range liquidity, external to this dealing range or trading range. Okay. So obviously I called this bullish, and you can see the example of that on my Twitter. It was shared this week. My entry here, as we went down below, I'm buying those sell stops in the form of external range liquidity with the anticipation that I'm going to pair it up with the buy side external range liquidity above this high. Well, what does that mean? Well, if you look at that range here, the dealing range high and the dealing range low, and then we remain inside that dealing range. Dealing ranges, just like consolidations, are fractal. This large consolidation, until we went above it here, housed all of this price action. Within this larger shaded area, there was this dealing range here. There's a dealing range right in here. There's a dealing range right in here. Okay, so, and even on a smaller time frame, in the seconds time frame, you can see a small little dealing range right there. All of these things fit together like a puzzle. Okay, so if I'm going long here and I'm buying south side external range liquidity, I need to find opposing buy side external range liquidity. So my mind was set up to think that this high would be a likely draw on liquidity. The buy side liquidity resting above that would be in the form of external range liquidity because it's outside the range that price has been trading in until we get to it here where my orders were filled. Okay, so again, I recorded it, showed the trade. It is what it is. The point is this. I look at this setup probably a dozen times a week because the market's usually working inside of a consolidation of some degree. All I need to know is where's the next likely draw on liquidity. So I'm stripping the market down into where's the draw? Is it bullish or bearish? And if it's in line with what I'm expecting, and I was expecting, some push higher on index futures early on in the week. Now, I'm not trying to claim the closing price being higher or lower. I just opened up the idea this week that I would look for a continuation higher. So that's where we're at. That's what we saw here. So if you're looking at this model, it's just a matter of knowing what it wants to do, going higher or lower. And if it's going to go higher, or if you're correct in your analysis, we wait for the market to break below a dealing range for external range liquidity in the form of sell side. So that range that's defined here and the bigger shaded area here, both sides of their buy side liquidity here and here were the draw on liquidity. So you can see when we got to this point here, right equal with that high, then it accelerated, ran real quick for this one because this is the larger pool of liquidity. So the algorithm is not going to waste time just because it goes here. That's not doing anything. And this might be taught by other educators, books, authors, whatever, those that don't really know what they're talking about. They're going to say that the buying pressure sent price up here, when in fact all it was the algorithm spooling to get to this price level before all the orders are pulled out of the marketplace. So it's not buying pressure that ramps it up here. They'll say, oh, the buy orders here caused that short covering rally to take it up to here. No, the algorithm already knew down here that it wants to go for these and here because that's where smart money would look to offset distribute, like you see me executing here. Okay, so it's not a matter of buying pressure that pushes it up there. It's a matter of algorithmic price delivery. So if we're bearish, we're looking for dealing ranges to see buy side external range liquidity tagged, entered into the marketplace there short, and then look for external range liquidity in the form of sell side to pair that up with this model. This pattern repeats very often because it's fractal. It appears in second charts, minute charts, 15-minute charts, hourly charts. It's all over the place. There's a plethora of setups that are available to you, but you still have to incorporate the measure of bias and understand time of day and day of week. So by blending those elements, you'll be able to find setups, a great deal of them, across the spectrum of a week or a month. You can make this model very complicated, or you can strip it down to what I'm showing you here. Okay, the ideas and foundation to using this model I've already given you in the trading plan and in the presentation about this particular model. But if you can just look at price like this, understand this part of it, when you go back into studying this model through the presentation and trading plan, it'll mean a whole lot more to you, because the foundation needs to be understood here. And once you understand what it is you're looking for, you don't have to complicate it. It's just a matter of buying below old lows and then selling it to old highs when you're on side with the bias. So hopefully you found this one insightful. Until next time, be safe.